Hey, what's going on today, guys? My name's Hayden Crabtree. I'm here today to show you how to look at a real estate investment. And I made this free tool called the Real Estate Analysis, which is a pro forma for those who know what it is. I made this tool. It's a free tool you can download if you want to grab your copy. Just click on the link, take you to the spreadsheet, then you click File, make a copy, and you can make a copy of your own. The goal of this sheet is to help you when you're looking at a real estate deal compare apples to apples. If you want to know if you're looking at deal A versus deal B, which of these two deals is better if you can only do one. So you need to be able to talk whether you're raising money to talking to an investor, whether you're investing your own money. You need to know what are your cash on cash and what are your IRR of a property going to be. And that's what this sheet does. So I'm going to help you dive right in, learn how to use this. I made this sheet extremely simple. I automated a lot of the work for you guys. You just need to come in here, and where there's green boxes, you need to fill it out. So what we're going to do today is I'm going to walk through a deal. I've got a couple here that we're going to look at. We're going to walk through a deal together. I'm going to fill out a deal, and you guys are going to be able to use this video as a tool when you're underwriting deals and look at investments for yourself. You can use this tool as a method to compare. So get yourself a free copy of this, and let's get started in this video. All right, so I'm going to go to Bigger Pockets Marketplace, and Bigger Pockets is just a forum, and they have a marketplace. If you go to biggerpockets.com, find a deal, real estate listings. So today's February the 18th. You can come through and look at any number of these deals, and we'll just pick, let's see, we want one that has price and rent. So we'll pick this one right here, okay? So it's $78,000, current rent of $750. Okay, so let's take a look at this property, and we'll just run through. They've got some information here for us to look at, but we're going to do it on our own to see if what they're saying is right or not. So overall, the property looks pretty good. Looks like it might need a dishwasher or a stove there. Looks like it's been remodeled. Looks pretty good on the outside. So what we're going to do is we're just going to come over here, and we're going to start entering information in. So they want $78,000 for this. So in the purchase price, we're going to put $78,000. Initial improvements. Let's say that we need to buy. Let's say there's no initial improvements needed. So we're going to put 0 in there. And let's say for closing costs, it's going to be $2,000 in closing costs. Okay. And now we're going to come down to our debt summary. So if we're going to use a bank to finance this deal, we want to enter in what kind of a loan we're going to get on it. So I'm just going to enter in here. I think that rates in the market on February 18th for a single family home, you could probably get 4.5% at an 80% LTV over a 30-year period. So if you notice in this cell right here, B11, this is in months. So 30 years, 30 times 12 equals 360. And what this does is it goes ahead and it computes our monthly mortgage payment for us, and it tells us how much our loan is going to be and what our down payment is. So the down payment is 20% of $78,000 plus our closing costs. So in order to buy this rental, you need either of your own money or of an investor's money. You need $17,600. Okay, so that's the general purchase information. You only have to fill out a couple cells here. Then we're going to come over to the income analysis tab. And I made this sheet so you can analyze either residential properties like the one we're looking at here as rentals, or you can look at commercial properties, which that's another video, which is why we have so many different tabs here. Each of these tabs is going to be a unit. So if we had multiple units, we would have multiple tabs going down here, and it would compute all of our income. But since we're looking at residential, we're only going to fill out this first box here. And it is a 2-bedroom, 1-bath, and it's renting for $750. So we're going to go, it's a 2-1. Monthly rent is $750, and there's only one of these units. Okay? And what you see happen over here on the right, for over a 20-year time period, it's going to forecast out our income. Now, there's a quick note that you need to know that you can determine as you underwrite this. There's a difference between PGI and EGI. PGI is potential gross income. That is, if we took $750 and we collected the full $750 for all 12 months, that would come out to $9,000. But the reality of the situation is that maybe every year we have somebody move out and they're gone for a little bit, and we don't collect 2 weeks worth of rent or whatever it may be. And that's where this vacancy rate factor comes in. So I like to leave 5% in there. If you have a property that you know you have a hard time getting a tenant in, then it may be 10% vacancy. Now, on the other hand, if you have a really hot rental that is completely full, the day somebody moves out, the next day somebody wants to move into it, you might have a vacancy rate of 0. So as you watch the difference between the potential gross income and the effective gross income, you can see as we alter this vacancy rate, it's going to change. So if we have more vacancy, we're going to collect less money. If we have no vacancy, then we're going to collect more money. So we collected all the money if our vacancy is rate 0. I suggest you leave 5% if it's a good market and it's a good property. The other number that we need to fill out here is our rent growth rate. And this is, could be set inflation. That's why I like to leave 2% in there, because inflation is set at 2% by the Federal Reserve. But if you're in an area where rents are growing really fast, like Orlando, where rents have grown at between 4 and 6%, depending on the product, maybe you want to enter in 4 here. But you can see what the difference is as we change this rent growth rate, our income in year 2, 3, and 4 are all going to change. So let's enter a rent growth rate of, say, 4% and see what happens. So you can see now we're making $10,000 in year 4, whereas if we leave it at 2%, we're only making $9,500, and after vacancy, $9,070. So I suggest you leave 2% in there because you will see rent growth rate, but I wouldn't get too aggressive with it. Now we want to come over to our expense analysis tab. And by the way, here's what this sheet's doing. As we enter in information, it's going to automatically come over and put our information in our pro forma tab, where it's going to stack all of our numbers up for us to analyze in one fell swoop. So as you enter in information, it's doing all the work for you behind the scenes. So now we want to come over to our expense analysis tab, and this is where we want to enter in all of our expenses. So we're going to pay property taxes. Let's say on this rental, it's $2,400 a year. That would come out to $200 a month. So right here, we're going to enter in the monthly rate of our expenses. So $200 a month, we're going to see that brings in $2,400 a year, and that's going to go ahead and start casting out our expenses over a 20-year period. Just like on the income side, where we had our rents go up, here we're going to have our expenses go up as well, and I like to leave that at 2% for inflation. So we're going to see both our income and our expenses go up, as you see here. If you believe it's going to be higher expenses, you can put 3%. I like to leave 2% as a minimum. We want our expenses and we want our income to grow, because we know over time that's going to happen. So we want to prepare and be ready for that to happen. Now we're going to enter in our insurance. Let's say our insurance is $600 a year or $50 a month. Let's say we're going to do, $100 of repairs a month. Say we don't have any software, payroll. Let's say we have $10 a month of bank fees. So we have $40 a month of pest control. We do our own accounting. We do our own lawn care. We do our own marketing. And let's say the tenant pays for power, and we as the landlord will pay for water. Okay, so let's say water is $35 a month. Now, another note here is that if we have a management company, we're going to want to put a management fee in here of some percent. And what this is going to do is it's going to take the management fee as a percentage of your income. So if you're paying a management company 6 or 8%, you just want to enter it in this green box, and it'll automatically calculate it for you. Well, let's say you manage this property for yourself, so there's no management fee. Okay, now we want to come over here, and this is going to take all of our information and put it in one central tab. So the first place we want to look is the green boxes. And since this is a residential property, it's going to be based off of the fair market value. So we want to put in what is the fair market value for this property. Now, we know that this person is asking $78,000 for this property. So let's just say the fair market value is $78,000. Now, that may not be the case. They could be asking more than the property's worth. They could be asking less for the property's worth. You need to do the research to figure out what is the property actually worth, so that you can accurately look at fair market value. And whenever we do look at fair market value, this is going to cast whatever the property's worth out over a 20-year period, just like it is your income and your expenses. This is your profit and loss statement up here. This is looking at your cash flows. And this right here is your balance sheet. This is looking at your property value, how much you owe the bank, and how much in equity you have tied up in that property. So both of these play into what kind of returns is the property going to yield. So you want to pay attention to both of these. Now, we also have 2 other boxes. We have a sales commission, and we have a value increase rate. Just like we had expenses go up and we had income go up, the value of our property is also going to go up over time. Now, we could say the value of the property is going to go up by the rate of inflation, which houses have generally outpaced that. But if you're betting on your house to go up in value to make a good investment, then it's not a good investment. You want your property to have positive cash flow, and you want to be assured that your property value is going to go up over time as a bonus. Okay, so I like to leave in terms of houses. I don't want to bet on my house going up. I don't want to buy it at 100 and bet in 3 years that it's going to be worth 200,000. That's unrealistic, and that's gambling. What I do want is to say, okay, my house is slowly and incrementally going to go up in value, because that's how things work. So we leave a value increase rate at the rate of inflation, which is 2%. And as you see, each year the value of the property is going to go up. And then we have sales commission, which is if we were to sell the property, how much would we pay a realtor? So maybe you're only going to pay a realtor 3%. I would say you want to leave it between 5 and 6% to be safe. And then, so now we're going to dig in. Now we've got our green boxes. We're going to dig into exactly how does this property look as an investment. And we can look here. We have our potential gross income minus our vacancy, which we talked about, equals our effective gross income, and then we have our expenses. So our effective gross income minus our expenses gives us our net operating income. If this were a commercial property, we would value our property based off of the net operating income. But since this is a residential property, we're going to use the property value and the fair market value. So now that we have our net operating income, which is essentially our profit before debt, we need to take our debt out, our mortgage payment out, to see what is our cash flow going to be. So we have a net operating income of $3,330, and we have a debt service of $3,794. So before our debt, we would have made a profit of just over $3,000, but because we paid the bank, we're actually losing $464 a year. So this tells me one of two things. This tells me either I'm paying too much for the property, my debt is too expensive, or this isn't a good deal. So one thing we can do now that we have all of our information inputted that is really cool is we can come back to the purchase information tab, and let's say we want to figure out how much we need to offer on the property so that it is cash flow positive. Well, the cool thing is that whenever you change this purchase price number, let's say we want to offer $70,000. When you change this purchase price number, the amount you need to put down as well as your monthly payment are both going to automatically change. So just enter in $70,000 and come back and look at your pro forma, and now you can see that our net operating income is still $3,300, but our debt service went down. So before we were losing $470 a year, and now we're only losing $74. So that tells me we need to go back and we need to offer even less than $70,000. So maybe we need to offer, let's call it $60,000 on this property. Again, our debt service went down a little bit, and now we finally have a positive cash flow. Our net operating income stayed the same. Now we're only paying the bank $2,900 a year, and we're going to be cash flow positive $411 a year. Okay, even though we're cash flow positive, though, it may not be a good investment. That's where we come over to figure out what does our returns look like on our money we invested. So we're going to come to the return analysis residential, and we're going to look at our cash on cash column. So this tells us for every dollar that we put down in terms of the down payment, which is, again, is back here, how much did it cost us to buy this property out of our own pocket? How much as a percentage of that did we receive in cash flow every single year? This property, even at the $60,000 mark with $14,000 down, we're only making a 2.9% cash on cash, which is horrible. Okay, you guys should be shooting for at least 10, if not 15 to 20% cash on cash. So in order to hit your goal, you need to come back here to the purchase information, and you need to enter, call it, let's say $45,000, and let's see what kind of cash on cash that gets us. Now we're at a 10% cash on cash on this property. Okay, so now we're at a 10%. We still would like to get higher on that. So let's say we need to offer, let's call it $30,000 on this property. Okay, now we're making a 23% cash on cash. So the truth is, is this person going to be willing to sell their property for $30,000? Maybe not, but now we know this investment isn't for us. What this also tells us is that while some people will pitch you really good deals and tell you that the property is a 19% ROI with $284 of cash flow a month. Let's see, 284 times 12 is over $2,000 a year. We just did our own personal analysis to figure out that if I pay these guys $78,000 for this property, what is my cash flow on this property going to be? It's not $248 a month. The reality is we're losing $460 a year, whereas $284 a month, would be $3,400 a year. So what this tells me is they're lying, and I don't want to buy this property, and I need to get really good at underwriting properties so that I can spot opportunities and also spot what I should not invest in.